Welcome, everyone. I'm Mary Brown Sands, Head of Marketing and Communications for the Small Business Investor Alliance, the leading association for small private equity and credit funds and investors. SBIA works on behalf of its members as an advocate for public policies that promote competitive markets and robust domestic investment for growing small businesses. SBIA not only delivers a valuable policy voice in Washington for our members, it also offers connection to an exclusive program of partner-level networking, deal sourcing, and market update opportunities through highly curated regional events and private equity conferences. Access for general partners and limited partners to fundraising, deal-making, and investing focused on small business investors, critical policy and regulatory updates, and access to the policymakers whose decisions impact how you manage your fund and your investing strategies. SBIA is pleased to continue our 2024 Lunch and Learn webinar series with today's session on ESG implementation stories from the field, where experienced professionals from FORVIS will share real-world examples of ESG implementation for private equity sponsors and portfolio companies. Before we get started, I'll mention a few housekeeping items. In your Zoom menu bar at the bottom of your screen, please find the Q&A feature. If you have questions during the webinar, please submit them here. Also, please use this feature to let us know if you're having any technical issues. Today's technical director, Ainsley Stoy, will reply with suggestions. Please note that this session is off the record. Comments, statements, and materials are not to be published or recorded without approval by SBIA and the professionals at FORVIS. Since 2020, SBIA has produced 27 educational webinars, providing valuable content for our members and industry colleagues, as well as the management teams of investor-backed portfolio companies. However, we could not provide these high-level and cost-free opportunities without the collaboration of our exceptional sponsors. Today's session is made possible by the support of longtime SBIA sponsor, FORVIS. Ranked among the largest public accounting firms in the United States, FORVIS has 6,000 dedicated team members who provide assurance, tax, and consulting services to clients in all 50 states and internationally. It's my pleasure to welcome Annika Maslowski and Nate White to lead today's discussion. Annika is a licensed professional engineer with more than 15 years of experience in environmental consulting and compliance. Nate is a CPA with experience providing audit and consulting services for public and private companies and works extensively with private equity-backed companies. Annika, it's my pleasure now to turn the virtual podium over to you to get us started.
That's great, Mary Brown. Thank you so much for that intro. And welcome, everyone. Welcome to ESG Implementation Stories from the Field. We've got a picture here of somebody running in a cloud of smoke, but don't worry, we're not going to be doing anything that aggressive this morning. This is just to breathe a little life into a topic that is exciting in its own right, but maybe not as much as this lady is having on her day. So we can go to the next slide and just do a little more intro and kick us off here. Okay, yeah, as Mary Brown said, my name is Annika Maslowski. I'm a director out of our Houston, Texas office for FORVIS. I'm on our ESG and climate risk team. And I'm an engineer by trade. I've been consulting in the energy space mostly in private equity for private equity clients for almost 20 years, actually, and been over a multitude of issues as they emerge, and ESG dovetails nicely into one of those emerging regulatory issues that our clients are paying attention to. And Nate?
Thanks, Annika. Happy to be here today. My name is Nate White. I'm based in Kansas City, Missouri. Go Chiefs. It's been a great couple of years here cheering for the hometown team. Like Annika said, I'm a CPA by trade. I have a background in external financial audit. I have a lot of experience with internal audit as well, and I sit full-time in our ESG and climate risk practice, focusing on ESG metric assurance. If you go to the next slide here, we've got just a high-level agenda I wanted to share with you of what we're trying to accomplish today. Not expecting anyone on the call to be an expert on the area of ESG or sustainability, and so we wanted to give a bit of an overview and how this might specifically apply in the private equity space. For those of you who have a little bit of background, the regulatory landscape is very much evolving. That landscape will be discussed in detail by Annika and myself to give you an idea of why should we care about this? What pending regulations are coming down at the state and the federal level? We'll dive into the California climate rules and the SEC climate disclosure rules, and then spend a little bit of time talking about the specific application to private equity. We also want to take you through a number of case studies showing you some real life examples of projects we've completed with portfolio companies and or sponsors. Hopefully that'll get the juices going in your brain about what your company, your firm, your portfolio company may need to be thinking about. And then we'll wrap up a little bit with how to prepare. What are some good next steps and so on and so forth. One thing I want to highlight for anyone on the webinar today is please use the chat function to ask questions. We'd love for this to be interactive. And if there's a topic that we're talking about that we can help explain a bit more, we'd love to do that. If you go to the next slide. Similar to Annika here, don't worry, there will be no rollerblading. I'm quite clumsy, and it looks like they have the old school 4 instead of the inlines. But wanted to give a high-level overview of ESG. If you go to the next slide, ESG stands for environmental, social, and governance. It really encompasses a variety of topics, multiple teams and stakeholders, very much multidisciplinary. Sometimes synonymous with sustainability, term you might hear is corporate social responsibility or CSR, environmental compliance. Really at its core, it just revolves around risk management, process improvement, and safeguarding that shareholder value. One of the interesting parts here is that ESG metrics are very non-financial in nature and have a lot of difficulties in measuring. So that data is often fragmented, incomplete, inaccurate, or simply unavailable as companies are building up their processes. The disclosures of your related, say, greenhouse gas emissions or opportunity parity are often reliant on estimates. And so that just adds a little bit of complexity. So with that as background, why does this matter to companies in the private equity space? ESG performance has been linked to drive business success and influence investor decisions. There's also a significant piece out there with supplier compliance. And then, as I mentioned earlier, there's regulatory compliance as well. Integrating those ESG principles can unlock a lot of growth opportunities, obviously the mitigation of risks, and then hopefully driving a little bit of those business success and the evolving societal expectations. If you go to the next slide here. Thanks so much.
Yeah.
I'll kick it over to Annika.
So what we wanted to get into a little bit, just to set the stage here for this presentation, is the landscape of ESG. And there are a lot of acronyms on this page. I think that's what kind of gives ESG a bad rep, is that it has been to date sort of an alphabet soup of different frameworks, different standard bodies, different buckets that clients or customers are trying to comply with, and it can be very confusing. So to date, I would say the majority of ESG disclosures, of those non-financial data disclosures, have been voluntary in nature. And over on the left-hand side, you see some of the frameworks that have emerged as different ways that companies can tell their story about their ESG journey. So some that come up a lot are the Task Force for Climate-Related Financial Disclosures, which is now actually part of ISSB, the acronym below. There's been a lot of merging and amalgamation of these standards bodies into each other and kind of morphing to evolve in more simplified, more standardized frameworks for ESG disclosures, which has been messy, but is heading in the right direction so that companies can clearly articulate their non-financial metrics to their stakeholders and have those metrics be comparable with their peers.
And Annika, I'll chime in here. For those watching, don't worry about taking notes. There's no test afterwards. We'll actually make the slides available, and any of these frameworks have some great resources out there to learn more about them if they think they're applicable to your organization.
That's right. One I wanted to call out just for this group is the United Nations Principles for Responsible Investing. That is a voluntary framework that is geared really towards private equity. It's focused on GPs and LPs being able to disclose or align their investment policies with certain criteria that the PRI calls for, which just being a member of that PRI communicates to your stakeholders or when you're capital raising, that your investment policies meet certain standards that are following that framework. And you can go actually on the website, just a Google of UNPRI, you can see companies that have committed to the principles for responsible investing. Maybe you'll see some peers on there or yourself on there, maybe some surprises. So that's maybe a good exercise for this group as you get started in ESG. One other new trend in the market is a lot of these voluntary frameworks are heading toward regulatory compliance. So to date, they've been voluntary, but now we're starting to see emerging regulations in Europe and the US with some of the regulations we'll get into shortly. And that is really changing the games because you're going from voluntary to compliance-driven reporting for some of these non-financial data metrics.
And Annika, I was going to say, before we go to the next slide, something I was just noticing. So in the bottom left-hand corner, you'll see the topics right there. And if you remember from slide I mentioned earlier, so you've got E, environmental, and then you've got social and governance. A lot of those topics are in that E, environmental space. And what we're seeing in the industry and what that's called is climate first. So as again, evolving landscape, voluntary disclosures, many companies are leading with and starting with the E of ESG. And then as they progress in their maturity, layering in some of the social and governance metrics and targets as well. Any thoughts on that topic?
I mean, I would just say, coming from my background, E is a lot more straightforward than the S and the G. The S, the social, you get into some pretty complicated, hard to discern social issues that are hard to kind of put your finger on. And same with governance. I mean, a lot of companies have been doing really good things in governance. Obviously, that's why they're successful companies for a long time. But figuring out how to talk publicly about it can be a little less straightforward than some of the E topics. So
yeah, and it's interesting too, you know, you talked about things that they've been doing well for years, good governance, being respectful of the environment, treating their people right. A lot of what we find in working with new clients is they dip their toe or jump full on into this ESG space and publish their first report or go through assurance, whatever it may be. A lot of what companies have been doing for years as part of doing good business and being a good steward is actually leverageable into this ESG framework. And depending on it, they can take credit for it even in a regulatory sense, which I always thought was interesting.
that's absolutely right. Yeah, this is not a new concept. Like the Global Reporting Initiative, for example, has been around since the 90s. People have been putting out sustainability reports since early 2000s. It's just a way to differentiate yourself in the market and a way to talk openly about non-financial risks and opportunities as a way to encourage stakeholders
and really being driven by stakeholders, whether that be employees, a board, or oftentimes investors saying, we want this information to help us align our investment priorities, which is, it's just interesting how that landscape's evolving.
Definitely. Yeah, and I think just the last thing to mention on this slide is where this information shows up. Like I mentioned, historically, there have been standalone ESG, sustainability, corporate impact reports, but as things start to become more regulated, we're starting to see ESG type disclosures show up in financial statements and 10K reports that actually will be, and we'll talk about the SEC rule coming up, but that will actually be required for compliance moving forward for some of these ESG disclosures. And then, yeah, go ahead.
I was just going to say, you know, as you're looking to learn more about the topic, pick a favorite company, you know, public generally, that you maybe invest in or frequent as a customer. Go onto their website and find their, you know, sustainability or corporate social responsibility section of that website. And oftentimes these large Fortune 500 companies have a published report on a yearly basis that outlines what they're doing in this space. In the bottom right-hand corner, you'll also see the online reporting platform. Some companies are taking an approach of having a live updatable kind of section of their website instead of publishing a PDF with historical information, which is analogous to financial statements, and saying, hey, we want to have a live working document where we can update as we go, and that kind of be our one-stop shop for our sustainability in the marketplace.
Good. We can move to the next slide. There she is again. She's having so much fun.
We love her.
Hope you guys are having fun. Yeah, so to dig in a little bit to these regulatory developments, and we're focused mostly US based. There's a lot going on in Europe, a lot going on in the rest of the world, but for this audience, thought to focus on what's going on here domestically. So California, and this is pretty typical of how most regulations go, like Europe goes first, then California goes, and then the rest of the US catches up in some of these emerging issue developments. And so true to form, California published last year in 2023 a few bills, Senate bills and Assembly bills related to climate disclosures. And so there's a few thresholds that your company or any of the portfolio companies that you have in your fund may be impacted by if you have more than $1 billion in revenue for Senate Bill 253, and you are doing business in California, which we'll talk about here in a minute, then you're required to submit or to publish your greenhouse gas emissions inventory. That's scope 1, 2 with assurance. So some third party validating that the data you're publishing is correct and accurate, and also a phase-in requirement for scope 3 reporting. We're not going to get into too much of the greenhouse gas protocol or how to calculate greenhouse gas emissions, but suffice to say, scope 1 and 2 are pretty straightforward. It's kind of what you can get your arms around and you directly impact as your company, your entity. Scope 3 is a little more ambiguous in that it deals with the emissions coming from your supply chain and the customers who are using your products or your portfolio company's products. And so that's a little bit more difficult. Especially in the private equity space, you might be talking about financed emissions. So that also adds another layer of complexity to the disclosures in SB 253 if you do trigger some of these reporting thresholds. SB 261 actually will impact a broader number of companies, so more than 10,000 US-based companies, and that is related to climate-related financial risk. It is aligned with the TCFD, which is an acronym from the last slide, but it basically says you follow this framework and you report publicly about the risks and opportunities related to physical and transition risks posed by climate change. And these have different phase-in requirements. So like we've got on this slide, first report by January 1, 2026. This is all a little bit up in the air because the California State Air Resources Board is set to publish this into law or formal regulation by January 1 of 2025. So the deadlines may shift, keep an eye on that. But if you are triggering like the 500 million or $1 billion revenue and you have operations in California, this is something to start thinking about because these aren't overnight disclosures that can be developed.
And Annika, we'll probably hit on this in a couple slides, but just to make sure we're real clear here, is that $1 billion of revenue in the state of California?
The way that it's currently written, it is $1 billion at the corporate level, and then you do business in California. So
I could have the majority of my revenue outside of California, trip one of the thresholds. We'll talk about them here on a slide here in a minute, but meaning I could be headquartered in another state, I could do the majority of my sales in another state, but have some type of operations in California, and these laws I would be subject to. Kind of crazy.
That's right. That's how it's written and interpreted currently, but there's a few different ways it might play out that we'll touch on. I'll just throw out here the AB, the Assembly Bill 1305 is if you are, and this kind of has more to do with if you've set ESG targets already, if you've set maybe net zero targets or greenhouse gas emission reduction targets and you're using carbon offsets, or if your business is generating carbon offsets in order to meet those goals or help other companies meet those goals, then there's an additional reporting element in that AB 1305 that will be compliance driven. Next slide. Yeah, so we talked about most of this. I think suffice to say that the runway that is given in the regulation as they're currently, or in the Senate bills as they're currently proposed, feels like a long time away. But in actuality, most companies that have any sizable operations and are not currently doing anything in this space will need quite a bit of that runway in order to get ready for these reportings. So although the deadlines may shift, it's definitely not something to take a wait and see approach on. Next slide, please. And here's this doing business in California definition. We thought we'd give you just a couple of different ways that the California Air Resources Board might choose to interpret doing business in California. So it may turn out when it's all said and done that you do have to have a certain portion of your annual revenues created or earned in California in order to trigger some of these thresholds. It's not currently written in, but they may decide to add that. That would be consistent with how the franchise board, tax board defines it. But then there's also precedents for some other broader interpretations, which is like if you're actively engaging in any transaction for the purpose of financial gain or profit in California, then you're doing business in California. So TBD on how that finalizes, shakes out, but just know that that could be broadly or narrowly defined. And then we did include some penalties for noncompliance. They are listed here on the right. I think with any sort of ESG disclosure, the big thing is transparency and good faith effort. You are protected by some safe harbor rules, like if it's your first time reporting greenhouse gas emissions, you can't quite get the data you need. There's a lot of flexibility in the greenhouse gas protocol to estimate calculations and be protected by some safe harbor built in the rules for some additional runway in the first couple of years of your reporting. But if you just choose blatantly to not comply, there are some hefty fines that could be set. Next slide, please.
So moving over to the SEC climate disclosure rules, we'll take a little bit of a history lesson here. So over 2 years ago in Q1 of 2022, the SEC published proposed climate disclosure rules, and those were met with quite a bit of feedback, to say the least. Over 24,000 comment letters were provided to the SEC in response to those proposed rules. Took the commission about 2 years to get through all of those letters, make amendments, interact with stakeholders, and on March 6th of this year, the SEC published rules to support more consistent and comparable climate-related risk disclosures. Those rules are highlighted here. Kind of the lead is that Scope 1 and Scope 2 GHG emissions, and that's for large accelerated filers and accelerated filers. And then also require disclosures aligning to that TCFD framework that we keep seeing coming up again and again. These are split between Regulation SK and SX from a SEC reporting perspective, and will be included in your annual report or your second quarterly report, depending on the topic, to give companies a little bit more time, which was some of the feedback that was taken from the SEC from the public, saying that, hey, there's a lot of cost of implementation. We don't think we're going to be ready for this. And so there was additional materiality thresholds and phase-ins, and allowing some of those smaller reporting companies and emerging growth companies to not have to apply. So that's where we kind of sit today. Also, about 2 or 3 weeks ago, the SEC faced a bit of legal pushback once the finalized rules were published. So finalized rules published in March of this year. A few weeks later, or over the next couple of weeks, they faced lawsuits from various entities saying this is outside of their jurisdiction and unconstitutional, so on and so forth. And so earlier this month, the SEC voluntarily issued a stay, which means that they are holding and pausing on these rules while they go through legal proceedings. In the same breath, they said they're vigorously going to defend these rules and believe they're within their jurisdiction to require them. So a lot of moving pieces. We keep using the word evolving, but something to keep an eye on. And we recognize that this audience is largely in the private equity and non-public space. So what's the applicability for private markets? Well, if you're a publicly traded private equity firm, that would obviously apply to you. And if you look in the lower right-hand corner, we have some specifics on that. We also recognize that portfolio companies doing initial public offering is potentially an exit opportunity. And so when making those IPO plans, going through ESG due diligence, preparing disclosures, recognizing what filing status you will potentially have and for how long will greatly impact some of these SEC climate disclosures. And then the last thing too is just about the registered investment advisors. So that would be the first time that the SEC has required disclosure of a specific aspect of that investment process by RIAs. Really interesting stuff that may be something that gets pushed back, but we'll stay tuned and hopefully learn more soon. If you want to go to the next slide here. So specifically for investment advisors and investment companies, wanted to highlight a few different fund types and their related definition, and then there's disclosure requirements. So if you're an integration fund, an ESG focused fund, or an impact fund, you can see the definitions there in the middle column, and then there's respective disclosure requirements that are incorporated into the investment process and required to be disclosed by these various funds. So that obviously adds a layer of implementation and cost. And in the SEC rule, there's actually very interesting data about the cost of implementation for the first year, but then also years moving forward at various filing status levels, recognizing that a very large Fortune 100 large accelerated filers will have additional and costs above and beyond what you'd expect from a smaller accelerated filer or an investment advisor. So something to keep an eye on, especially if you're currently in the private equity space and maybe moving up or becoming a registered investment advisor. Wanted to highlight this for the group. So if you go to the next slide, just
sorry,
talk.
I'll chime in.
Yeah,
Sorry,
please, come on.
So this one is especially interesting to pay attention to because it would be the first time that the SEC is requiring potentially some intellectual property disclosed about investment strategies. And so that will be something that I think especially impacts this group and it will be interesting to see how that plays out. As far as the disclosures around the different types of funds, just from a global context, this is pretty standard for what we're seeing in Europe and the UK and other major developed countries, is that they're all trying to get to the bottom of what does it mean to be ESG, to have an ESG fund or to be a green investment fund. And so they're developing, like there's an EU taxonomy under the Sustainable Finance Disclosure Rule. There's the UK taxonomy. This is kind of getting at the same thing, just trying to make it defined on what that actually means so that people can decide where they want to put their money.
Yeah, great point, Annika. And it brought up two other topics that might just be helpful to touch on briefly. One is, we've kept this presentation and talk largely domestic, but when you look internationally, the EU especially is a couple years kind of ahead of us. And so we're able to look into the crystal ball a little bit and see what's coming down. Granted, it's a very different capital market, very different regulation structure, even within the various companies. And so that's one thing that I just think is really interesting moving forward. We want to go to the next slide. So again, just to summarize a little bit here about some of the regulatory applicability, Anna, do you want to take us through some of these, and I can maybe finish us off at the end?
Sure. Yeah, just I think to keep an eye on these regulations as they evolve. Nothing happens overnight here in the US, but they are trending towards publishing some disclosure. And although the SEC does have some aspects that will touch private equity and private companies, the California rule does blatantly state that it's public or private relevant. So it doesn't offer some of that protection that the not being public might for other jurisdictions.
Yeah, one other area, just anecdotally, that we are seeing is bank covenants that are implementing ESG metrics with some basis points up for grabs if you hit and improve upon your targets year over year, and then punitive damages if you're not hitting and filing those. And so just another interesting angle as it relates to debt facilities. So let's go to the next slide here. So thought it would be helpful to run you through some real life examples. And before we do, just real quickly, for those of you who don't know us, like Marianne mentioned, we're a top 10 public accounting firm. We've got deep private equity experience. We offer assurance, tax, and consulting services. And so our ESG and climate risk team is really built to serve private equity clients. And one thing to mention, just so you're aware and not confused, if you see us in a couple months, effective June 1st, we're forming a top 10 global network with Mazars, which is an international accounting firm. And so wanted to just share with you a little bit about us. We can go on to the next slide and kind of jump into the first of our case studies. So wanted to walk you through, we have a portfolio company that is being required by its sponsor to not only report their GHG, so that's greenhouse gas emissions, but also have them assured by an external third party, which in this case was us. So engagement had a really tight turnaround. Management, unfortunately, there was some communication where they had some issues understanding timeline and deadlines, and so those due dates got pushed out. We came to the table. We're able to figure out an engagement and approach with them. Calculation was prepared by another firm for the portfolio company. So the portfolio company said, "Hey, we need some help doing this." Went out and hired a consulting firm to help. And then they obviously, for independence reasons, right? You can't audit your own work, needed to hire a different firm, in this case, us, to do the auditing. And we took that calculation, and there were some adjustments identified related to building types. And so different building types have different emissions profiles. And we're looking at offices versus warehouses, and that resulted in a material adjustment there. So then at the end of the engagement, what the kind of output, right, for the portfolio company is they received a formalized report similar to an audit opinion if you go and look at a 10K, that the limited assurance was provided by us, and then that was submitted to their sponsor. But then in addition to that, one of the things we always try to do is provide a list of management recommendations for future go-forward improvements. Those might not have been things that held up the audit or prevented us from issuing an opinion, but we see a lot in the marketplace, and we always want to offer best practices for companies that are looking to improve over time, and then see that next year that process goes a little bit smoother. Annika, you want to take the next slide?
Sure. Yeah, so this slide has to do with an aspect of the ESG field that we didn't quite touch on yet, which is the ratings and rankings organizations that we find are impacting a lot of customers or companies' business and their investors. So there's a number of entities out there that are either manually or using bots to scrub public websites or just even your company website, looking for certain keywords, certain ESG disclosure criteria, and then providing you a score, almost benchmarking you against your peers. And that's kind of whether you ask them to or not, which can really be a thorn in the side of a customer or a president of a company that all of a sudden they've got a shareholder or investor asking questions about why they're ranked lower than their peers in a rating that they didn't know they were even a part of. So this one, Preqin, was actually is actually specific to the private equity space. So it's focused on GP and LP investment strategies, and has a number of criteria frameworks that they use to grade, for better term or worse terminology, companies against each other. We had a client come to us, kind of same situation, where like all of a sudden they had an investor question, like, why are you scoring lower than this other fund in Preqin? And we'd like to understand what the differences are. And that sort of caught that company off guard, that president off guard. And we worked with him they were doing a lot of stuff that would have given them a score improvement already. It was just that they weren't disclosing it. And so we helped them craft a ESG disclosure that was made publicly available so that Preqin could pick it up and improve their score so that they didn't look like they were lagging against their peers in the market. And I think that's kind of the trick to a lot of this ESG stuff is you're probably already doing, or your portfolio companies are probably already doing a ton that would meet these criteria, these different frameworks, these different raters. But if you're not talking about it and the information isn't readily available, you're not always given the opportunity to provide it. There's also a lot that you can do just in wording certain things in alignment with frameworks. That is a little bit of a game that you're playing, but it's good to understand who's looking at your data and who cares. So,
Yeah.
next slide.
Annika, just before we hop to the next slide, had a great question come through the chat. Let me read it and I'll take a first pass and then you can layer on anything I forgot. So the question that came through, and thanks for the participation, whoever submitted this. So the question is, can you speak to the anti-ESG regulatory push coming from a number of states and how you see this playing against California's push or moves by the SEC and others at the federal level? Really interesting topic, right? A lot of strong opinions in the room, as Annika smiles. Here's what I would equate it to. So I walked through the SEC rule a minute ago, and just to revisit that, 2022 Q1 rules were published that were more stringent, right? Over those next 2 years, comment letters, right, largely against the rule or asking for some clawback, said, what can we do differently? The SEC did take a good amount of that feedback. Enough is up to interpretation, depending on who you are and your opinion on the topic, but materially made changes, including really blowing out the applicability timeline and the phase-in to give companies quite a bit of time. You know, assurance doesn't come through until something like 2029. Disclosures for smaller reporting companies, the accelerated filers, are pushed out as well. And so this is giving companies more time to implement. There's also materiality thresholds that if we don't think this is a material part of your business and would influence an investor decision, allows you to kind of a get out of jail free card. And so we've seen this push or push back impact the SEC rule already. California is really interesting because in, I believe it was Q3 or Q4 of 2023, so last year, Governor Newsom signed these bills into law. In the same breath as signing those bills into law, he pushed CARB, the California Air Resources Board, to take a good hard look at the implementation costs and the applicability of this to the number of companies that were going to be impacted. And so that is their task for calendar 24. My guess would be there would be some sort of following of materiality thresholds, phase in. If you look at the timeline for California, it's really, really fast. And I think a lot of companies would fail based on the current timeline. And so throughout the year, they're taking that and coming back, and I would expect there to be some sort of ease back on that. And then there's some other state applications out there or rules and regulations that are being considered, but California is really the biggest one we see. I'll pause there. Annika, anything to layer on or your thoughts, even if it's a different take than mine?
Yeah, I mean, I think in general, like ESG is a polarizing catchphrase, but at the root of it, it's transparent disclosures of risk, of real risk, that's just maybe less financial in nature, but has financial implications. So I don't think that the regulation is, I think investors have been asking for this data, and the regulation is probably going to lighten the reporting burden for a lot of companies, because now it's put in stone what you have to report to, as opposed to trying to pay attention to all the frameworks at once and do everything that your investors could care about. This would be sort of a standardized, get everybody on the same playing field for disclosure. So from that aspect, I think the regulation will actually ease the reporting burden and the confusion around ESG and allow companies to broadly differentiate themselves in the market with non-financial KPIs.
Yeah, agreed on the market. And the other thing too is you have employees that are wanting to know more about what their company is doing with the environment and society, so on and so forth. So I think there's a multitude of stakeholders here. If we can go to the next slide, we'll keep running through our case studies here. So this was a really cool project where I talked earlier about the sustainability report, ESG reports that again are made publicly available for a number of companies. And this was a private equity firm that needed assistance creating those, really, so driving that reporting. And so we were able to do end-to-end creation for the annual ESG reports of each of their funds. And then in addition to that, similar to the assurance engagement I mentioned earlier, we performed a gap assessment on existing opportunities for ESG disclosure. The disclosure landscape's really broad, and so you can start small or start very focused and then look at, hey, we want to branch into this. Year over year, there's a lot of changes in those reports, and so it's interesting to see as companies will continue to mature and evolve in this space. Excuse me. We also compared it against various ESG frameworks, so SASB, GRI, CDP, and the UN SDGs. And so that way their data collection was improved, consistent, trying to have that transparent report at the end of the day for their users. I'll kick it over to Annika for the last one.
The last one we wanted to talk about today is providing education. So something that we do a lot of, I know this slide will catch up here in a minute. Something we do a lot of is providing just instruction, context, bespoke, situational advice and level setting with executive teams for some of these different voluntary or regulatory frameworks. And I think it's really helpful to have everybody on the same page. It's so much to try to digest as one person, but if you're able to do maybe a working session where you get your executive team all on board with like, okay, what is TCFD? What does it mean for my company? Are we already doing some things, which you probably are, that could be considered disclosure aligned for the TCFD? Having some of those working sessions with a consultant or third party, or if you have someone on your team who's especially passionate or knowledgeable on this, is a good first place to start. It's also something that you can say publicly, like without doing a lot, just even getting training and getting smart about what's happening in the ESG space is a positive disclosure statement that you could make on your website. Without a lot of effort, that just shows investors or stakeholders that you care and you're paying attention to what is coming for your company and future strategy building. So next slide. There she is again. Readiness planning. This is going to wrap us up here. Just some suggestions for how to get started. So the training that we talked about might be a good first step if you're not currently doing or thinking about anything ESG related, but you're doing business in California, or your investors are asking some questions about, MSCI's rating index, and you haven't paid attention to that of yet. So some training might be good. I think also we talk a lot about like gap assessments. Nate mentioned that a few times in the case studies. It's a good idea just because what we find is a lot of companies are doing so much that they already aren't thinking of as ESG, but they're just thinking of as good business practices. And aligning that, arranging that in whatever way that the disclosures require can be very valuable without a lot of effort. So those gap assessments are helpful, but we do a lot of building of, 5-year roadmaps, 5-year strategy or 2-year strategy plans, remediation plans, just something that can fit into your business as usual operations, but still get you to whatever hurdles you're trying to achieve, and get some of these ESG pieces, non-financial KPIs built into your long-term plan.
I was just going to highlight real quick too, something else to consider is where does this live within your organization? This is very multidisciplinary, very much multiple internal stakeholders. So understanding, is this going to be in your CFO office? Do you have a sustainability or environmental compliance department? Do you think this is more investor relations? And making sure that it's a little bit of a balancing act between having someone with ownership, but making sure that your input from various stakeholders is being considered. And so we see a wide variety of where sustainability, ESG, reporting, et cetera, regulatory compliance sits in the organization, and figuring out what's best for your organization is one of those key questions that you want to answer early on.
definitely. Talk about IPO on the next slide.
Yeah, and just to wrap up our time here, as mentioned earlier, we recognize that a potential exit for portfolio companies can be that initial public offering. So really depending on your filing status, right, and how large that offering, hopefully you're up in one of the big tiers early on for your own benefit. But you know, considering that emerging growth company eligibility and the SEC climate disclosure rules really allow the SRCs, the smaller reporting companies, and the EGCs, the emerging growth companies, to have a bit of a longer leeway and not be have all of the regulations be applied to them. Those disclosures that are applicable would need to be in that section adjoining your S1 filing. And so listed here on the slides are just considerations on kind of the planning phase, the preparing, and then the being the public company. And the independence attestation is really one of the big areas along with those disclosure requirements that you'll need to consider. We go to the next slide. You know, really just thank you all for the time here today. Enjoyed chatting about this. Appreciate the questions in the chat. There was a couple we didn't get to today, and we'll follow up individually on that. On the screen here, you'll see a variety of our service offerings for ESG in the private equity space, and really our charge or recommendation as we conclude our time here. We really urge you to consider establishing your firm's ESG strategy and governance. Keeping an eye on the evolving regulatory landscape. We know it's a lot to digest, but should there be something we can help you with, we'd love to continue the conversation.
Great. A huge thank you to Annika and Nate for this very helpful discussion. If we were not able to address your question, as Nate said, the FORVIS team has generously agreed to respond after the webinar. And a replay of this webinar, as well as the slide deck, will be available in the webinar gallery on the SBIA website, and also in the SBIA member info hub. SBIA members can access additional ESG resources in the info hub, as well as sign up to receive a monthly ESG newsletter that provides a selection of industry relevant perspectives and updates that's curated by SBIA's ESG working group. SBIA's final regional conference of 2024 is coming up May 29th and 30th in Chicago. The Midwest Deal Summit features deal links, an exclusive deal sourcing opportunity for fund managers and investment bankers. Also, SBIA's Women Investors Networking Council is holding a Rising Professionals Networking Breakfast on May 29th in Chicago alongside the Deal Summit, which FORVIS is generously hosting in their Chicago office. Conference attendance is not required to attend the event, but a separate registration is necessary. You can find details and registration links for the event on our website and in the SBIA membership newsletter. Finally, SBIA is excited to partner with the Independent Sponsor Forum. It's a new initiative designed exclusively by and for independent sponsors and capital providers. The next events in the forum's deal series are on May 14th in Nashville and September 12th in Chicago. These deal-making forums are invitation only to pre-vetted capital providers and independent sponsors. You can visit the Independent Sponsor Forum website at www.isponsorforum.org to learn more and to request an invitation to these events. Thank you again for participating in our webinar today, and we look forward to having you join us again soon.
Thank you.